Hello, everyone. It's Professor Rako, continuing on with our earnings per share chapter. One last thing we need to cover is what happens if we have an actual exercise or conversion during the year. So if you go back and when we did the convertible bond video, we looked at what happens if something was issued during the year. Remember, when we're doing diluted earnings per share, we go back to the beginning of the year or whenever they were issued. Okay, so now what we're saying in this example is they were outstanding at the beginning of the year, so we should go back to the beginning of the year to calculate their dilutive effect. What happens if they were actually exercised or converted during the year? What effect does that play on earnings per share? Okay, so remember, the actual exercise or conversion is an actual event, and that will affect the basic earnings per share as well. So we have a lot going on in this problem, and sometimes this gets a little bit confusing. So let's walk through it. All right, so we get net income, common stock. You notice this doesn't say during the year, it says beginning of the year. So that should tell you right there you're probably going to have some sort of stock transaction, which means you're going to have to calculate weighted average shares. All right, so stock options, 100,000. Exercise price is 9. And then on October 1st, the actual exercise of the options, okay? So the market price on that date was $15. All right. So we have an actual event, which means, remember, when you're doing basic earnings per share, you ask yourself, one, is there preferred stock and do I need to subtract a dividend? No, in this example. Question two, is there an actual stock transaction where I need to account for and recalculate weighted average common shares outstanding? The answer is yes here. So let's do that. So we had those tables that I set up in the previous videos. Remember where I had dates outstanding, shares outstanding, the percent of the year, and then I had a restate column if there was a dividend or split. There's not in this example, so I'm just going to skip that, speed things up, and that gives me weighted average shares. All right, so from the beginning of the year all the way up to October 1st, all we had was the beginning balance of 400,000 shares. All right, so you can see that's 9/12 of the month. Multiply that across, that's $300,000. 300,000 shares. From 10/1 to 12/31, we had an additional 100,000 shares, so we had 500,000 shares, and that would be for 3/12, and that works out to be 125,000. All right, so that means my denominator is 425. So now that we have that, we're ready to calculate our basic earnings per share. All right, which is, remember, is net income minus preferred stock dividend, which there's not one in this example. So we have 2.3 million of net income divided by 425,000 shares. All right, so that equals $5.41. All right, so this number right here, 425, that includes the actual exercise of the option. But by rule, we want to go back and see what the dilutive effect, had they been outstanding all year. I mean, we're going back to, we need to account for January. So this 425 accounts for October 1st at 12/31. We need to also account for the dilutive effect from January 1st to October 1st. Okay, so that's what we'll do now. All right, so these are options. So I'm going to do the treasury stock method. Okay, so come down here and I've got my proceeds. So I do this the same every single time. I take the 100,000 times the $9. I'm sorry, that's not a dollar sign there. That's 100,000 times the $9. Okay, so my proceeds are $900,000. The shares needed were 100,000. The treasury stock that we could purchase. Okay, so we're going to take the 900,000, and since there was an actual exercise during their years, we use the price on that date, which was 15. We can buy 60,000 shares. All right, so that means we have incremental shares of 40,000. Now keep in mind it's weighted average, so these were only potentially dilutive from January 1 up to October 1st. So I'll just put 1 through, and I'll just put 9/30. Okay, so 9 full months. And so that equals 30,000 is the incremental shares that we're going to be dealing with. All right, so we're going to put that in now to diluted earnings per share. Remember, diluted, we start with basic, so we have the 2.3 million. Oops, sorry. Over the 425,000 shares. and then always 0 on top for warrants and options, plus 30,000 on the denominator, and that equals 505. Okay, so that's how we would do that if we had actual exercise during the year. Now look, just to be clear here, this over here includes actual exercise of the options. Okay, so that number includes that number includes 10-1 to 12-31, the options. This number is the potential dilution that would existed at the beginning of the year. So this accounts for January 1st through September 30th. So we have the whole year accounted for with these options now. Okay, so that sometimes gives students a little bit of trouble there, and I get that. I can see where that'd be a little difficult because you're thinking, well, if we actually, why do we even care if they actually were exercised during the year? They weren't outstanding at the end of the year. But remember, we go back to the beginning of the year when we're dealing with options, or we're dealing with any diluted security, the beginning of the year or whenever they were issued. So these were outstanding at the beginning of the year. So we need to go back and account for that period at the beginning of the year. That's the January 1 to 9/30 dilutive effect. Okay, so that's another example, one that gives you another example of looking at the treasury stock method with options and warrants, but it also kind of brings in this new, unknown. If something is actually converted or exercised during the year, how do we handle it? So now we know how to do that. All right, so I hope that helps a little bit with that. I hope you're enjoying the videos. Please like this video if you enjoyed it, and subscribe if you're enjoying these as well, because I'll be putting out a lot more. And be sure to tune in next time. I believe the next one is our last video, and we're going to walk through a comprehensive example doing basic and diluted earnings per share. So I'll see you next time.